This video is presented for information purposes only, and it is advised to seek investment advice from a professional or do your own research before investing. SmartCentres Real Estate Investment Trust is a strategic investment choice in a changing economic landscape. SmartCentres continues to solidify its position as a leader in the Canadian real estate market, particularly within the retail sector. Known for developing and managing a significant portfolio of strategically located properties anchored by leading national retailers, SmartCentres stands out as an investment opportunity as of September 2024. This review will delve into why SmartCentres is a compelling choice for investors, assess potential upside and downside risks, and evaluate its positioning against competitor stocks in the industry, especially in light of the recent decline in interest rates. A quick overview. As of the third quarter 2024, SmartCentres manages an extensive portfolio comprising approximately 167 properties located across Canada. It has a strong emphasis on essential and experiential retail tenants, including industry giants like Walmart, Loblaws, and Costco. In response to changing market dynamics, SmartCentres has strategically transitioned into mixed-use development, combining retail, residential, and commercial spaces to meet increasing demands for multifunctional properties. SmartCentres has consistently demonstrated robust financial health. The company reported a significant revenue increase of about 7% year-over-year as of September 2024, reinforcing its capacity to generate stable cash flows. The current occupancy rate of about 98% highlights the REIT's effective management and strategic lease agreements. In addition, SmartCentres offers an attractive dividend yield of approximately 6%. This yield not only satisfies income-focused investors, but also demonstrates SmartCentres' commitment to providing consistent returns. SmartCentres has maintained an impressive track record of increasing dividends, including a 5% hike in distributions over the past year, especially noteworthy given the broader pressures faced by various retail REITs. A significant consideration for investors is the recent trend of declining interest rates, noted as beginning in the third quarter of 2024. After a prolonged period of rate hikes aimed at combating inflation, economic indicators suggest a shift towards lowering rates to spur growth. This changing interest rate environment presents several advantages for SmartCentres. Falling interest rates reduce financing costs for real estate investment trusts, enabling SmartCentres to pursue additional development projects and acquisitions with less expensive capital. This decrease in borrowing costs can lead to enhanced profitability, allowing the REIT to invest more in growth initiatives that drive long-term value. As interest rates decline, the attractiveness of REITs, including SmartCentres, tends to increase in comparison to traditional fixed-income securities. Investors seeking yield may favor REITs, leading to increased demand for SmartCentres shares and potentially driving up its market price. Lower interest rates can nurture consumer spending by making loans and credit more accessible. This in turn may boost retail sales as consumers feel more confident in their purchasing power. As retail tenant performance improves, the overall revenues for SmartCentres could also benefit significantly. In addition to the favorable impact of declining interest rates, SmartCentres possesses substantial upside potential. SmartCentres' proactive focus on mixed-use properties creates opportunities for diversification and resilience. By integrating residential components into its portfolio, the REIT taps into the growing trend of urbanization and responds to the significant demand for housing near retail and commercial spaces. This strategic alignment with demographic trends enhances both asset value and potential revenue streams. The stability provided by a diverse array of national retailers as anchor tenants fortifies SmartCentres' revenue. National brands consistent in their performance, such as Walmart and Costco, deliver a strong buffer against economic fluctuations. As recovery in the retail environment takes hold, these anchor tenants are likely to experience increased customer footfall, directly benefiting SmartCentres. As environmental responsibility becomes increasingly important to investors, SmartCentres has embraced sustainability practices across its developments. Adopting energy-efficient designs and renewable energy initiatives not only enhances the company's appeal to environmentally conscious investors, but also positions the REIT favorably for regulatory changes that may impose stricter environmental guidelines in the future. While SmartCentres has several growth opportunities, potential investors should be aware of the inherent risks in the retail sector. The ongoing rise of e-commerce poses a significant threat to traditional brick-and-mortar retail, and by extension, to the performance of retail REITs. Although SmartCentres has diversified its offerings, A continued shift toward online shopping may impact tenant sales and occupancy levels, particularly among less dominant retailers. Economic uncertainty. Despite a trend of declining interest rates, broader economic uncertainties persist. Factors such as geopolitical tensions, inflation, or unexpected economic shocks can lead to fluctuations in consumer confidence and spending patterns, which can ultimately affect retail performance and revenue generation for SmartCentres. A downturn in consumer spending during economic unease could contribute to higher vacancy rates and a decrease in rental income. While declining interest rates generally create a favorable environment for REITs, if those rates were to rise again unexpectedly, it could put downward pressure on property valuations. Higher interest rates might lead to increased capitalization rates, making it more difficult for SmartCentres to acquire new properties or enhance existing ones without a corresponding increase in property values. In comparison to other retail-focused REITs, SmartCentres demonstrates a competitive advantage mainly due to its strategic focus on essential retail and its solid management practices. Many of its peers have been heavily reliant on discretionary spending, exposing them to greater risks during economic downturns. SmartCentres' emphasis on a diversified tenant base featuring essential services and DIY retail positions it well for stability. Additionally, the mixed-use developments not only mitigate risks associated with retail, but also enhance overall portfolio value by attracting a broader customer base. Furthermore, the REIT has cultivated strong relationships with national tenants, resulting in high lease renewals and less volatility in rental income. This strong framework allows SmartCentres to effectively navigate potential market challenges while capitalizing on emerging opportunities. Looking ahead, SmartCentres REIT is poised for continued success, bolstered by macroeconomic indicators that suggest consumer confidence may recover as interest rates decline. The strategic emphasis on mixed-use developments positions the REIT to capture growth in housing demand while generating retail traffic. With retail sales projected to rise as economic conditions stabilize, SmartCentres is well situated to leverage its strong tenant relationships to navigate potential challenges. Additionally, SmartCentres' focus on sustainability will likely resonate with a growing segment of socially responsible investors, further enhancing its attractiveness. This commitment to responsible development can also mean long-term cost savings through energy efficiency and potentially reduces regulatory risks associated with environmental compliance. In summary, SmartCentres REIT represents a solid investment opportunity in the evolving landscape of the retail real estate sector. Its strong financial performance, impressive tenant roster, and strategic focus on mixed-use developments, combined with the favorable impact of declining interest rates, position the REIT favorably for future growth. However, prospective investors must remain mindful of the inherent market risks associated with rapidly shifting consumer behavior and broader economic uncertainties. While SmartCentres is well equipped to handle potential challenges, vigilance and due diligence are crucial for making informed investment decisions. In conclusion, SmartCentres REIT stands out as a strong buy for investors looking to maintain a balanced portfolio in the retail sector. The combination of its solid fundamentals, innovative growth strategies, and adaptability to changing market conditions aligns well with long-term investment goals. As SmartCentres continues to capitalize on economic trends and consumer demands, it is a compelling choice for both income generation and potential capital appreciation in the years ahead.